I'm going to explain why the dollar faces genuine structural pressure, but the collapse predictions circulating online completely miss the actual mechanism. Over 5 decades, I've bet billions on currency crises. I broke the Bank of England in 1992. I've watched the Asian financial crisis unfold in 97, positioned through the 2008 collapse, and navigated the European debt crisis in 2011. Dynamics remain consistent: excessive leverage, policy inflexibility, and the reflexive feedback loops that turn sustainable imbalances into inevitable crises. The recent headlines attributing dire warnings to me about the dollar imminent collapse distort what I've actually said. I did warn about unsustainable U.S. public debt in 1986. That warning proved premature by decades, which tells you something important about timing versus correctness. I've discussed the dollar's structural vulnerabilities repeatedly since then, including in 2011 when I argued the U.S. could absorb more debt if deployed productively, and in 2018 when I warned that dollar strength was creating dangerous capital flight from emerging markets. These positions seem contradictory if you treat them as predictions rather than context-dependent analysis. They're assessments of reflexive dynamics at specific moments. The difference between causing a crisis and recognizing one that's developing matters. When I shorted the pound, I didn't break the Bank of England through some shadowy manipulation. I identified an unsustainable policy position, a fixed exchange rate the fundamentals couldn't support, and I positioned accordingly. The contradiction collapsed under its own weight. My participation accelerated the timing, but the outcome was structurally determined. The same framework applies to the dollar now. There are genuine vulnerabilities. The timing of how they resolve remains uncertain. The mechanisms deserve explanation because they create specific investment implications for those who understand reflexivity. The dollar reserve currency status creates what I've called the imperial circle. Capital inflows strengthen the dollar, which allows the U.S. to run persistent deficits, which require continued capital inflows to finance, which strengthen the dollar further. This self-reinforcing loop appears stable until it reverses. The reversal happens when creditors lose confidence that future inflows will continue, or when the burden of accumulated debt creates inflationary pressure that erodes the currency's purchasing power faster than interest rates compensate. We're watching elements of both dynamics develop simultaneously in 2025. I'm going to walk through what's actually happening with the dollar, why the collapse predictions misunderstand the mechanism, what BRICS de-dollarization efforts actually accomplish versus what the rhetoric suggests, how the debt and tariff dynamics create genuine vulnerability, and where I see the inflection point that could trigger the reflexive reversal. This matters because currency crises develop slowly, then very fast. The transition from gradual accumulation of imbalances to rapid unwinding creates extraordinary dislocations. Recognizing the pattern before the acceleration separates those who profit from those who get destroyed. By the end, you'll understand why I'm concerned about the dollar's trajectory without predicting imminent collapse, why reserve currency status provides both resilience and vulnerability, and what the actual catalysts for crisis look like versus the sensationalized versions. The investment thesis flows directly from understanding these mechanisms. My 1986 warning about unsustainable U.S. public debt gets quoted frequently now, nearly 40 years later, as if it's a current prediction. The context matters. Reagan-era deficit spending, combined with Fed Chairman Volcker's high interest rates, created what I saw as an unstable combination. The U.S. was running twin deficits, fiscal and current account, financed by foreign capital inflows attracted by high yields. The mechanism seemed unsustainable because it required continuous foreign appetite for dollar-denominated assets, while the underlying economy faced structural challenges from deindustrialization and trade imbalances. I was right about the mechanism. I was wrong about the timing by decades. The dollar reserve status proved far more durable than I anticipated. Global demand for safe assets, the absence of credible alternatives, and the U.S. economy's innovation capacity allowed these imbalances to persist and grow without triggering the crisis I expected. This taught me something important about reflexivity and reserve currencies. The self-reinforcing loop can continue far longer than fundamental analysis suggests because the currency's dominant position creates its own justification, until it doesn't. The imperial circle concept I developed explains this dynamic. Foreign central banks and investors need dollar reserves for trade settlement, commodity purchases, and safe asset holdings. This demand allows the U.S. to issue debt in its own currency without the constraints other nations face. The Treasury borrows, the Fed manages interest rates, capital flows in seeking yield and safety, and the cycle continues. The dollar strengthens from capital inflows, making imports cheaper, allowing higher consumption financed by more borrowing. Each element reinforces the others. The vulnerability emerges when the accumulated stock of debt reaches levels where servicing costs consume growing portions of federal revenue, or when inflation expectations shift and creditors demand higher yields to compensate for purchasing power erosion. The U.S. national debt reached $38 trillion by October 2025, growing at roughly $70,000 per second over the past year. The fiscal year 2025 deficit hit $1.8 trillion despite revenue growth because spending outpaced receipts. These are the conditions that eventually break the imperial circle. My 2011 comment that the U.S. could absorb more debt to stimulate growth gets cited as contradicting my earlier warnings. The context was post-financial crisis, with interest rates near zero, inflation subdued, and massive output gaps. Productive investment in infrastructure, education, and technology would have generated returns exceeding borrowing costs. The debt would have been self-liquidating through growth. That window has closed. Interest rates are higher, inflation pressures persist, and the incremental debt finances consumption and entitlements rather than productive investment. The mechanism shifted from sustainable to problematic. The 2018 warning about dollar strength causing emerging market capital flight proved accurate in real time. When the Fed tightened policy and the dollar rallied, countries with dollar-denominated debt faced rising repayment costs in local currency terms. Turkey, Argentina, and others experienced currency crises. This validated the reflexive dynamic I was describing. Strong dollar begets capital flow to the U.S., which strengthens the dollar further, which creates stress in economies dependent on dollar funding, which can trigger broader financial instability. The feedback loop operates in both directions. What differentiates my analysis from the collapse predictions circulating now is understanding that these dynamics unfold through identifiable stages. Gradual accumulation of debt becomes problematic when servicing costs accelerate faster than revenue growth. Manageable inflation becomes destabilizing when expectations shift and wage price spirals embed. Sustainable capital inflows become vulnerable when creditors question repayment capacity or alternative reserve assets become viable. Each transition has triggers. None happen instantaneously. The reason my older warnings resurface during periods of stress is that the underlying mechanisms I identified remain operative. Debt accumulation continues. The imperial circle persists. The vulnerabilities compound. What changes is proximity to the inflection point, where the self-reinforcing loop reverses. We're closer now than in '86 or even 2011. The question becomes identifying the catalyst that shifts market psychology from assuming perpetual dollar dominance to pricing in meaningful depreciation risk. I've learned from being early that timing these inflection points requires watching market signals, policy responses, and alternative developments simultaneously. The bond market's behavior matters more than debt to GDP ratios. How foreign central banks manage their reserve composition reveals more than their public statements. The pace of alternative payment system adoption indicates credible threat emergence better than political rhetoric. These are the variables I track, not sensationalized predictions about imminent collapse. US dollar index closed at 99.27 on November 14, 2025, roughly 2 to 4% below January levels, depending on the specific measurement date. This decline contradicts the collapse narrative while confirming underlying pressure. The index measures the dollar against a basket of 6 major currencies, weighted 57.6% yen and smaller portions for pound, Canadian dollar, Swedish krona, and Swiss franc. Understanding what this basket captures versus what it misses matters for interpreting the signal. The year-to-date performance shows volatility rather than directional collapse. Early 2025 weakness drove the index from around 100 to below 98 by June. Partial recovery followed, reaching near 100 in October before settling at current levels. This pattern reflects competing dynamics. Fed policy expectations shift between rate cuts and sustained higher rates depending on inflation data. Geopolitical tensions drive safe haven flows into dollars during crisis moments. European Central Bank and Bank of Japan policy divergences create relative value changes. None of this suggests terminal decline. The reflexive element operates through expectations and positioning. When traders expect Fed rate cuts, they sell dollars anticipating lower yields, reducing foreign capital inflows. This selling weakens the dollar, which can accelerate if momentum builds. But if inflation data forces the Fed to maintain higher rates longer than expected, the reversal happens rapidly. Traders caught short scramble to cover, driving sharp rallies. The October 2025 rebound demonstrated this mechanism. Bets against the dollar unwound quickly when the expected monetary easing didn't materialize on the anticipated timeline. What the dollar index doesn't capture matters as much as what it does. The basket contains only developed market currencies, missing the emerging market dynamics where dollar stress shows up first. When the dollar strengthens against the Turkish lira, Brazilian real, or South African rand, the index doesn't reflect it because those currencies aren't included. The real stress from dollar strength often appears in countries with dollar-denominated debt and commodity-dependent economies. They experience the crisis before it shows up in euro-dollar or dollar-yen rates. The index also misses bilateral dynamics with China. Since the yuan isn't in the basket, China manages the yuan against a trade-weighted basket that includes the dollar but allows gradual adjustment. When China wants to ease financial conditions domestically, it allows modest yuan depreciation against the dollar. This doesn't show directly in the dollar index, but affects global capital flows and trade competitiveness. The mechanism matters more than the index level for understanding systemic pressure. I've watched currency indices throughout my career and learned they lag actual crisis development. The pound traded in a relatively stable range against the Deutschmark before September 92, then collapsed within days when the reflexive loop triggered. The index level told you little about the underlying unsustainability of the exchange rate mechanism. The same applies now. The dollar index hovering around 99 doesn't confirm stability or predict crisis. It reflects current market positioning and policy expectations, both of which can shift rapidly. The safe haven dynamic complicates interpretation. During geopolitical stress, risk-off flows drive capital to dollars, regardless of U.S. fiscal fundamentals. The Ukraine conflict, Middle East tensions, and China-Taiwan concerns all create periodic dollar strength from defensive positioning. This can mask underlying deterioration in the fiscal situation. The currency strengthens from fear, while the debt accumulates from deficit spending. Both can be true simultaneously, which confuses linear analysis. The Treasury market provides better signals than the currency index. 10-year yields, the spread between short and long rates, inflation break-evens, and foreign official holdings all reveal stress before the exchange rate moves. When foreign central banks reduce Treasury purchases or yields spike despite Fed policy stability, these indicate creditor concerns about sustainability. The currency follows the bond market, not the reverse. In '92, UK gilt yields surged before the pound collapsed. The sequence repeats. Subscribe if you want to understand how these mechanisms actually develop rather than relying on sensationalized predictions. I've spent 5 decades watching these patterns. The indices move, the headlines scream, but the underlying reflexive dynamics determine outcomes. If you're serious about seeing what's happening versus what surfaces in simplified narratives, you'll find this analysis valuable. Current positioning shows traders remain long dollars relative to historical averages, despite the modest year-to-date decline. This suggests vulnerability to negative surprises. If fiscal concerns accelerate or Fed policy disappoints dollar bulls, the unwinding could be sharp. Conversely, any geopolitical shock likely triggers another safe haven rally. The range-bound behavior continues until a catalyst forces directional resolution. Identifying that catalyst before the market thus creates asymmetric opportunity. The July 2025 BRICS summit in Rio produced predictable rhetoric about reducing dollar dependence without meaningful concrete mechanisms. This pattern repeats every summit. Political leaders announce intentions to trade in local currencies, discuss creating alternative payment systems, and emphasize gold reserve accumulation. The headlines suggest imminent dollar displacement. The actual progress remains incremental and faces structural obstacles that political will can't overcome quickly. BRICS expanded membership to include Argentina, Egypt, Ethiopia, Iran, Saudi Arabia, and UAE, alongside the original Brazil, Russia, India, China, South Africa bloc. This expansion increases the group's collective share of global reserves, now holding roughly 42% of global reserves. The political symbolism matters. The economic coordination required to actually displace the dollar faces enormous challenges from internal contradictions within the bloc itself. The blockchain-based payment system under development represents the most substantive technical initiative. The concept involves creating a distributed ledger infrastructure, allowing direct settlement between member central banks in local currencies, or potentially a new BRICS unit of account. As of mid-2025, pilot programs are testing cross-border transactions between select members. Broader rollout might occur by 2026 if technical and political hurdles get resolved. The ambition deserves attention even if execution lags promises. The structural problem BRICS faces mirrors what prevented the euro from immediately displacing the dollar despite the EU's economic size. Currency dominance requires deep, liquid financial markets where holders can deploy reserves. The U.S. Treasury market offers roughly $25 trillion of highly liquid, relatively safe assets backed by the world's largest economy and protected by the world's most powerful military. No BRICS member or combination thereof offers comparable depth and security. China's bond market faces capital controls. Russia's faces sanctions. India's lacks scale. Brazil faces volatility. The yuan's limited convertibility remains the critical constraint on any BRICS currency initiative. China maintains capital controls, preventing free movement of funds in and out of yuan-denominated assets. This serves domestic policy goals, preventing destabilizing hot money flows and maintaining monetary policy independence. But it prevents the yuan from functioning as a true reserve currency. Holders need confidence they can convert to other assets quickly without restrictions. Until China removes capital controls, which would sacrifice significant policy control, the yuan can't anchor a dollar alternative regardless of trade invoicing agreements. Russia's increased use of yuan and rupee for trade settlement following Western sanctions demonstrates both the potential and limits of de-dollarization. Russia needed alternatives for energy exports when dollar transactions faced restrictions. China and India purchased Russian oil in local currencies. This works for bilateral trade, but doesn't create a reserve asset. The yuan and rupees Russia receives must either be spent on Chinese and Indian goods or converted back to usable reserves. The circle remains constrained compared to dollar liquidity. Gold accumulation by BRICS central banks signals a genuine shift in reserve composition. The 2025 through 2030 strategy emphasizes increasing gold holdings as a hedge against dollar depreciation and sanctions risk. Gold provides an asset outside any single nation's control, carries no credit risk, and maintains value across political systems. The accumulation pace has accelerated. This matters for gold prices and signals creditor concerns about dollar-denominated debt sustainability. The gap between rhetoric and implementation reveals itself in actual trade data. Intra-BRICS trade in local currencies increased from roughly 15% 5 years ago to perhaps 25 to 30% now, depending on which members and sectors. This represents progress but falls far short of displacing the dollar, which still denominates approximately 60% of central bank reserves. The momentum exists. The scale remains insufficient to constitute a systemic shift. I've watched multiple attempts to create dollar alternatives over decades. The euro succeeded in becoming a secondary reserve currency but never challenged dollar dominance because the eurozone lacks fiscal integration and the ECB lacks the Fed's policy flexibility. The IMF's special drawing rights remain a technocratic construct without market adoption. Previous commodity-backed currency proposals failed because participants couldn't agree on governance. BRICS faces all these challenges simultaneously while including members with competing strategic interests. The investment implication isn't that BRICS dollarization is irrelevant. The gradual erosion of dollar dominance creates long-term pressure that compounds with fiscal concerns. Each percentage point of global trade that shifts to yuan or rupee settlement reduces demand for dollar reserves. Each central bank that diversifies from 70% dollar reserves to 60% represents reduced Treasury purchases. These marginal changes accumulate over years, creating the conditions for eventual currency adjustment. The reflexive element operates through expectations. If market participants believe BRICS will successfully reduce dollar dependence, they position accordingly, selling dollars and buying alternatives. This positioning itself weakens the dollar, which could accelerate the trend. But if technical obstacles prevent BRICS coordination, the positioning reversal creates dollar strength. Currently, markets price in modest long-term erosion without near-term displacement. Shifts in that expectation create trading opportunities for those monitoring actual implementation versus rhetoric. $38 trillion in national debt accumulated by October 2025 represents roughly 123% of GDP, depending on the specific GDP. measurement. The absolute number matters less than the trajectory and servicing costs. Debt growing at $70,000 per second, as occurred over the past year, compounds into trillions annually. The fiscal year 2025 deficit of $1.8 trillion continues despite revenue growth because mandatory spending on entitlements and rising interest costs outpace receipts. Interest expense on the national debt now exceeds defense spending and approaches $1 trillion annually. This occurred because accumulated debt reached levels where even modest interest rates generate enormous servicing costs. When rates were near zero from 2008 through 2021, carrying large debt loads appeared manageable. The Fed's shift to 5% policy rates transformed the calculation. New borrowing costs more. Maturing debt rolls over at higher rates. The debt service burden accelerates independent of new deficit spending. The reflexive trap operates through this mechanism. Higher debt requires more borrowing. More borrowing increases the stock of debt. Higher stock means greater interest costs. Greater interest costs increase the deficit. Higher deficits require more borrowing. The feedback loop becomes self-reinforcing unless broken by policy intervention. Either cut spending dramatically, raise taxes substantially, or inflate the debt away by keeping rates below inflation. Each option faces severe political constraints. Tariffs compound this dynamic in ways the advocates don't acknowledge. The projections suggesting $1.3 trillion in revenue from expanded tariffs over the current presidential term sound appealing for deficit reduction. But tariffs function as taxes on consumers through higher import prices. They feed directly into inflation by raising costs for goods and inputs to production. The inflation created by tariffs forces the Fed to maintain higher rates longer than otherwise necessary. Higher rates increase debt service costs, offsetting the tariff revenue. The data shows tariffs contributed roughly 10.9% to headline personal consumption expenditures inflation annually through August 2025. This inflation feeds into expectations, wage demands, and second-round price increases across non-traded sectors. The Fed responds to headline and core inflation, not the source. If tariffs keep inflation above the 2% target, rates stay higher. The debt trap tightens because the deficit reduction tool simultaneously increases the cost of the deficit through the interest rate channel. I've seen this pattern in emerging markets repeatedly. A country runs large deficits, finances them with debt, faces inflation from currency weakness or commodity prices. Central bank raises rates to combat inflation, higher rates increase debt service, deficit widens, credibility suffers, and the cycle accelerates until crisis forces adjustment. The US enjoys reserve currency status that allows this to continue longer, but the mechanism eventually operates the same way. Confidence erodes gradually, then rapidly. The bond market vigilantes I've discussed for decades haven't appeared yet because foreign central banks and domestic institutional buyers continue absorbing Treasury issuance. But their demand isn't infinite, and it's price-sensitive. Yields must rise enough to compensate for inflation risk and opportunity cost versus alternatives. When the Treasury auctions face weak demand, yields spike, which increases future deficits, which requires more issuance, which pressures yields higher. The reflexive loop triggers when creditors question sustainability. The political economy prevents the solutions that would stabilize the trajectory. Spending cuts face resistance from constituencies depending on programs. Tax increases face resistance from voters and ideological opposition. Entitlement reform remains politically toxic, despite demographic math making current promises unkeepable. The path of least resistance becomes monetary accommodation, where the Fed eventually pivots to supporting deficit financing through yield curve control or quantitative easing, regardless of inflation. This creates the inflation scenario rather than default scenario for dollar depreciation. The US won't default on dollar-denominated debt because the Fed can print dollars. But printing to finance deficits erodes purchasing power, which is implicit default through inflation. Creditors receive nominal dollars but real losses. This becomes rational policy when the political system can't adjust spending or taxes. The currency bears the burden of fiscal unsustainability through depreciation. The timing depends on inflation expectations becoming unanchored. Currently, markets believe the Fed maintains credibility and will defend the 2% target. Survey-based and market-based inflation expectations remain near 3% for 5-year horizons and below 3% for 10-year. If these expectations shift to 4 or 5% because fiscal dominance forces Fed accommodation, the dollar weakens significantly. The inflection point occurs when markets price in structural inflation rather than cyclical variation. I'm watching Treasury auctions, foreign official holdings data, and inflation break-evens for signals of this transition. The bond market will lead the currency market in revealing stress. When yields spike without Fed tightening, when foreign buyers pull back, when inflation compensation demanded rises persistently, these signal the reflexive loop approaching its inflection point. The debt trap closes when the mechanism becomes self-evident to the broad market. The dollar reserve currency status provides extraordinary privilege and creates profound vulnerability simultaneously. Understanding this duality explains why collapse predictions miss the mechanism, while complacency about perpetual dominance also proves wrong. The adjustment between current imbalances and sustainable equilibrium happens through identifiable channels. Recognizing which channel activates and when separates inform positioning from speculation. Reserve status means foreign central banks and institutional investors hold roughly $12.8 trillion of U.S. assets, approximately 60% of total global reserves. This demand allows the Treasury to finance deficits at lower rates than fundamentals would otherwise require. The convenience yield from dollar liquidity and safe haven properties reduces borrowing costs by perhaps 50 to 100 basis points compared to a scenario where the dollar competed equally with alternatives. This saves hundreds of billions annually in interest expense. The vulnerability emerges because this demand isn't guaranteed perpetually. It depends on creditors believing dollar assets will maintain value and remain accessible. Sanctions against Russia demonstrated that dollar reserves can be frozen for geopolitical reasons. This introduced a risk premium where countries facing potential U.S. conflict must diversify away from concentrated dollar holdings, regardless of economic efficiency. China, Iran, Venezuela, and others now actively reduce dollar exposure, not because concentration creates political vulnerability. The safe asset shortage in global markets has sustained dollar dominance despite fiscal deterioration. Global wealth grows faster than supply of highly rated sovereign debt. Investors and central banks need stores of value exceeding what German bonds, Japanese government bonds, or other alternatives provide. U.S. treasuries fill this gap at scale. But the gap closes as U.S. debt accumulates and credit quality questions emerge. The AAA rating the U.S. maintains becomes harder to justify when debt to GDP exceeds 130% and deficits remain structural. I expect the adjustment to occur through gradual depreciation rather than sudden crisis, but with periodic sharp moves during stress episodes. The mechanism resembles British pound sterling's transition from reserve currency to secondary status across the 20th century. Sterling dominated in 1900. By 1950, the dollar had clearly superseded it. The transition involved multiple devaluation crises in 1931, 1940, 1967, and a final float in 1972. Each crisis step-functioned the exchange rate lower until equilibrium reflected Britain's diminished economic position relative to the US. The dollar transition likely follows a similar pattern rather than binary collapse. The yuan, euro, and potentially digital currencies or gold gain share gradually. Dollar dominance erodes from 60% of reserves to 55%, then 50% over a decade. Each percentage point decline reduces demand for treasuries, forcing higher yields to clear auctions. Higher yields increase deficits, creating more debt, further reducing credit quality. The feedback loop drives gradual depreciation punctuated by crisis moments when policy errors or external shocks accelerate the transition. The reflexive dynamic I expect involves a shift from assuming dollar strength to pricing in structural weakness. Currently, any dollar decline gets bought as a tactical opportunity. Traders assume long-term dollar dominance with cyclical fluctuations around that trend. The inflection point occurs when this assumption flips. Traders begin assuming long-term dollar weakness, with temporary strength viewed as selling opportunities. The positioning shift from structural long to structural short creates persistent depreciation pressure. The catalysts that could trigger this shift include a Treasury auction failure, where primary dealers can't absorb issuance at prevailing yields, a foreign policy crisis causing major holder liquidation, Fed capitulation to fiscal dominance ending inflation credibility, or emergence of a credible alternative reserve asset through BRICS coordination or digital innovation. Each remains low probability in isolation, but collectively represent the investment implications flow from understanding adjustment through depreciation rather than default. Long-term Treasury bonds face duration risk from rising yields and currency risk from dollar weakness. Gold benefits from both reserve diversification and inflation protection. Equities with international earnings and hard assets provide inflation hedges. Emerging market debt in local currency offers relative value if the dollar weakens against the broad basket. The positioning requires conviction about the mechanism while accepting uncertainty about timing. I've positioned for currency adjustments multiple times over 5 decades. The successful trades shared common elements: recognition of unsustainable policy contradictions, identification of the reflexive feedback loop that would force adjustment, patience waiting for market catalysts to trigger the mechanism, discipline to maintain positions through volatility when directional conviction remained intact. The dollar faces each of these elements now: the unsustainable fiscal trajectory, the reflexive debt dynamics, the potential catalysts in bond markets and reserve diversification. The timing remains uncertain because policy retains flexibility. The US could implement fiscal consolidation, though political economy makes this unlikely. The Fed could tolerate higher inflation temporarily to reduce real debt burdens. Financial repression through yield caps could force domestic savers to absorb treasuries at below market rates. Each extends the timeline but ultimately reinforces the adjustment mechanism by creating distortions that eventually break down. My assessment is that we're in the late stages of dollar dominance sustained by inertia and lack of alternatives, approaching the transition to a multipolar reserve system. This transition occurs over years, possibly decades, but with accelerating pressure visible in current bond yields, reserve diversification, and de-dollarization efforts. The investment positioning should reflect this trajectory while respecting that markets can remain irrational, or in this case, structurally biased toward dollar strength, longer than leveraged positions can survive. The educational value here is understanding mechanism over prediction. I can explain why the dollar faces structural pressure from debt accumulation, fiscal deficits, reserve diversification, and reflexive feedback loops. I can identify the signals that would indicate transition acceleration. I remain uncertain about exact timing because that depends on policy responses and market psychology shifts that are inherently unpredictable. Those who understand the framework can monitor the signals and position accordingly based on their own risk tolerance and time horizon.